How does a 300-unit apartment community in Lakeland, Florida fetch a price tag of nearly $60 million? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In a significant transaction within the commercial real estate market, the Bridgewater Grand apartment complex in Lakeland has been sold for a remarkable $57.37 million. This 300-unit multifamily community was acquired by the Connecticut-based real estate private equity investment firm, Hamilton Point Investments. The deal was brokered by Berkadia, and it officially closed on July 10, 2025. Located at 5546 Autumn Ridge Road, the three-story garden-style apartment community sits on 31 acres and features a mix of 1, 2, and 3-bedroom units. Notably, 2- and 3-bedroom units make up 92% of the unit mix, with unit sizes ranging from 1,219 square feet to 1,853 square feet. The community is strategically positioned off State Route 33 and boasts a 95% occupancy rate. The previous owner, Trimcore, initially acquired the then-vacant land in 2019 for $2.5 million and commenced construction in 2020. Monthly rents at Bridgewater Grand range from $1,635 to $1,985, according to Apartments.com, reflecting the strong demand for rental units in the area. Hamilton Point Investments, which has been active in acquiring properties, has now added this community to its portfolio as its fifth acquisition in Florida. Hamilton Point has been a formidable player in the real estate market since its inception in 2009, having acquired more than 150 properties worth over $3.8 billion. The acquisition of Bridgewater Grand marks its first investment in the Lakeland region, highlighting the firm's strategic interest in Florida's growing real estate market. Let's explore an interesting trend that's been gaining traction in the commercial real estate landscape, particularly in the Chicago area. It's the phenomenon of business owners transitioning into real estate investors. This shift is more common than you might think, as outlined by Stephen M. Vernon III, Senior Vice President and Group Head of Commercial Real Estate at Signature Bank. Often, business owners sell their companies but choose to retain the buildings. Some entrepreneurs experience a liquidity event and decide to diversify their portfolios. Others, having retired from their initial ventures, find themselves drawn to the opportunities presented by commercial real estate investment. However, these individuals are stepping into a field that is capital-intensive, deadline-driven, and nuanced. In the Chicago area, where privately held and family-owned businesses are a significant part of the economy, real estate becomes a natural next step for many business owners as they transition or evolve. But this move carries substantial financial implications. These first-time investors often possess strong financial acumen and operational expertise, but may lack familiarity with the unique aspects of the real estate sector. They face a new vocabulary with terms like bridge to perm, retrade, or bad boy carve-out that might seem foreign. Unlike institutional investors, these individuals make deeply personal decisions, whether it is purchasing a building for a second-generation business or repurposing a familiar neighborhood site. Real estate becomes more than just a product, it becomes part of their new identity. For these new investors, capital access is only part of the equation. They often require guidance on deal structuring, the correct debt-to-equity mix, realistic timelines, and identifying risk signals. Adjusting to real estate means adapting to different processes and new stakeholder groups and redefining their understanding of risk. Beyond investor profiles, the geography of investment is shifting too. In Illinois, increasing property taxes and economic uncertainty have pushed many Chicago-based investors to explore other markets. These investors bring their expertise to local markets but face challenges in capital access due to a lack of local track records. In these situations, personal trust becomes a constant, while market knowledge is a variable that can be acquired with time. For many business owners, real estate investment is less about maximizing internal rates of return and more about applying the instincts that made them successful in their previous ventures. It's about finding value, managing risk, and making bold, informed decisions. With the right support, real estate can seamlessly become a profitable extension of their business acumen. Jody Van Dam from Republic Bank of Chicago highlights the ongoing transformation within Chicago's commercial real estate market in 2025. This transformation is being driven by changing business needs, evolving demographics, and shifting investment strategies. The demand continues to rise in sectors such as industrial, multifamily, and mixed-use development, with retail also regaining strength in urban corridors. These trends are reshaping neighborhoods and creating new momentum across the city's real estate landscape. Districts like Fulton Market, Bronzeville, and the West Loop are attracting both residential and commercial investment, becoming hubs for live workplace communities. The redevelopment of underutilized properties, especially older office buildings, is opening doors for innovative reuse. This is making space for housing, co-working, retail, and hospitality in previously single-use areas. Industrial and multifamily properties are leading the way, with industrial real estate being one of Chicago's most active sectors. With e-commerce growth continuing and demand for last-mile delivery space increasing, developers are building and retrofitting facilities near major transportation routes. Chicago's central location and logistics infrastructure make it a top choice for regional distribution. Multifamily properties continue to perform well as urban living remains in high demand. Limited new construction has helped maintain strong occupancy and rent growth. Developers are prioritizing proximity to transit, energy efficiency, and modern amenities to appeal to both young renters and downsizing homeowners. Amid these challenges, several opportunities are emerging for those with a long-term view and the right strategic approach. In Kitchener-Waterloo, Ontario, similar trends are observed, particularly in the industrial and multifamily sectors. The region's proximity to major transportation routes makes it attractive for industrial development, much like Chicago. Multifamily properties are also gaining traction as urbanization continues to rise, with developers focusing on modern amenities and transit-oriented locations. The cross-border relevance highlights the universal nature of these trends in urban centers across North America. Urban infill development is gaining momentum as underused office buildings are targeted for residential or mixed-use conversions, creating new value in high-demand neighborhoods. Public-private partnerships and incentive programs are unlocking new potential in Chicago. The city is actively working to revitalize its downtown and surrounding areas, offering financial support to projects that contribute to affordable housing, job creation, or adaptive reuse. Developers with flexible capital, local insight, and a strong team are well positioned to capitalize on these programs and reshape the city's commercial footprint. However, the market does face challenges. Office vacancies, particularly in older buildings, continue to challenge property owners. Rising interest rates, increasing insurance costs, tighter credit, and fluctuating construction costs add pressure to new and existing developments. Despite these hurdles, developers and investors with creative strategies and strong banking relationships are finding ways to overcome these barriers and move projects forward. Let's shift our focus now to Lisle, Illinois, where NAI Hiffman, a prominent Midwest independent commercial real estate firm, has successfully completed 3 office leases totaling 15,642 square feet at 2,200 Cabot Drive, a recently renovated office building in the Corporate Lakes Office Park. This is a significant milestone for the building, which has undergone extensive renovations to attract new tenants. Among the new tenants is Syngenta, an agriculture company that signed a 13,381 square foot lease in the 5-story building. Before the pandemic, Syngenta was located in nearby Downers Grove. Patrick Kiefer, executive vice president with NAI Hiffman's Office Services Group, noted that many companies that went fully remote during the pandemic are now returning to the office in some format, seeking to balance efficiency and productivity. The building owner, RE Development Solutions, was represented by Kiefer in the lease negotiations with the 3 new tenants. In addition to Syngenta, Bethany Christian Services signed a 1,217 square foot lease, and Retirement Solutions leased 1,044 square feet. With these transactions, 2,200 Cabot Drive is now 70% occupied, a remarkable turnaround from just 5% occupancy when RE Development Solutions acquired the building in November 2019. The renovations have been extensive, including a redesigned lobby, updated first and fifth floor amenity suites, a new on-site deli, exterior monument signage, building conference room, updated common corridors and washrooms, and new mechanical systems. Jeremy Sabowicz, leasing director at RE Development Solutions, expressed that by reinvesting in high-quality finishes, amenities, and move-in-ready spaces, they have been able to attract a diverse mix of tenants and bring new energy to both the building and the corridor. The building offers spec suites to meet demand from small and mid-sized companies seeking turnkey space. It also features nearly 400 surface parking spaces and 29 heated underground executive parking spaces, a common loading dock, and on-site ownership and property management offices. Currently, one divisible floor of about 33,000 square feet remains available, along with 4 move-in-ready suites ranging from 2,200 to 33,000 square feet. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.